Michael Burry just recently predicted a bullwhip effect for the market. But what exactly does that mean? That's something that I'm going to cover in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into this. You can see here that Michael Burry put out a tweet saying the supply glut at retail is the bullwhip effect. Google it. Worth understanding for your investing endeavors. Deflationary pulses from this, which leads to disinflation in CPI later this year, which causes the Federal Reserve to reverse itself on quantitative tightening, and thus this whole cycle continues. But what exactly does that mean? Because if we're going to be honest, he was very vague with his tweet, but I think part of it is just he just expects you to understand what the bullwhip effect is, and if you don't, you can just Google it. And so I did Google it because that was the first time I actually heard the term bullwhip effect, but it means exactly what you think it would mean. So you can see here. So effectively what he's saying is that small changes in demand at the retail end of the supply chain could become amplified when moving up the supply chain from the retail end to the manufacturing end. This happens when a retailer changes how much of the good it orders from wholesalers based on a small change in real or predicted demand for that good. The danger of the bullwhip effect is that it amplifies the inefficiencies in a supply chain as each step up the supply chain estimates demand more and more incorrectly. This can lead to an excessive amount of inventory, which is kind of what we're seeing right now, lost revenue, declines in customer service, delayed schedules, and even layoffs or bankruptcies. So effectively what he's saying is that the high amounts of inventory was essentially the bullwhip effect, where these companies bought up a lot of inventory, and really it kind of permeated at the end of the supply chain as well, because all of these retailers just had a lot of supply that came in. And by all estimates, they obviously purchased all that supply purposely. But what it also means is that there's probably a glut in the warehousing and the supply chain going backwards as well. So if the retailers are liquidating all this inventory, what do you think the wholesalers and manufacturers are doing as well? So that's probably happening. But what he's saying is that what could happen in this environment is these disinflationary sales that all these retailers are having could signal to the Fed that their rate increases are working, and thus they'll scale back on their quantitative tightening. But what that will do is it could potentially cause the consumer to return, and now there's just not a lot of supply, which once again pushes up the price for products, which signals the bullwhip effect again. But on the glut side, you continuously go through the cycle, because then of course the Fed will want to increase rates again and quantitatively tightening, and then you just continue going through that cycle. So that's kind of how I'm interpreting it. But if I'm misinterpreting it, guys, let me know in the comments. And so my first question is, who are the retailers that could potentially be impacted by this? I know that Walmart and Target would probably be there, but who else? And so there was actually an article or a blog that actually discussed this. So you can see here, The Investor's Place, a gentleman by the name of Eddie Pan wrote this article where he said that there are 7 retail stocks at risk of Michael Burry's predicted bullwhip effect. So there's Target, whose inventories are up 43% year over year. There's Bed Bath & Beyond. There's Walmart, whose inventories are up 33% year over year. There's Lowe's. There's Abercrombie & Fitch, which is actually a name that's on my tracker. And then there's Macy's. In fact, Target and Walmart are both on my tracker as well. And so going into the next exhibit, you can see that Target and Walmart, these companies have teams set up to predict consumer demand, and they use these predictions to align with suppliers and adjust inventory levels accordingly. But here's the problem. They get it wrong sometimes, right? So if retailers have too much inventory in hand, then they may lower prices to attract more demand. So basically just liquidate this stuff out. You're not even taking a huge margin on it. Just get it out so you can get more in-demand stuff on the floor. Burry believes that falling retail prices may lead to lower consumer price index readings, which may cause the Federal Reserve to stop hiking interest rates and engage in quantitative tightening. So exactly what I believe that he was sort of getting at there. And then, of course, you would think that this would cycle the other way as well. So I think that's what he's saying. And so these discounted sales may hurt retail's revenues and margin in the near term, and I think it could potentially even result with bankruptcies right up the supply chain. And so let's dive into one of these. Target is a name that I do have on my tracker that the Patreons get access to. And so what did this article have to say about Tracker? Well, you can see here, during Target's Q1 earnings call, I did cover this on the channel previously, their CEO, Brian Cornell, did explain that he thought it was prudent for Target to be decisive and act quickly and get in front of the inventory glut and address and optimize their inventory in the second quarter. And thus those actions were necessary to remove the excess inventory and set themselves up to continue to be guest relevant with their assortment of inventory. And Target's not alone in that sentiment. You can see here, Walmart's CEO John Furner admitted that about 20% of the company's merchandise is merchandise that it wishes it didn't have. The company is currently holding significant discounts on products ranging from baby strollers to televisions in an attempt to clear out its inventory. And Walmart expects its inventory challenges to improve in the coming quarters as warmer weather attracts consumers to purchase more seasonal items. And then the last one, Abercrombie and Fitch. Abercrombie stated that it had stocked up on inventory to protect against potential supply chain disruptions. And now the company has reduced its full year 2022 outlook in response to economic headwinds like reduced demand, and it now sees revenues flat up to 2% compared to prior estimates between 2 and 4% growth. However, I do want to point out to you guys that Abercrombie's shares after the last quarterly earnings calls actually went up on this news and not down. And the question is, why did that happen? Well, you can see here, Abercrombie came out with their midterm targets, and they're expecting that from 2022, they expect sales to grow at a CAGR of 3 to 5%. They expect operating margins to be approximately 8%, and they expect to have a minimum of $600 million in free cash flow generation between 2022 and 2025. And so they provided very strong guidance, in my opinion. And moving on, this is the model that the Patreons get access to, and I forecasted out the management's expectations. So you can see here that in 2022, their revenue is forecast to grow at approximately 1%. So I'm thinking around $3.75 billion is probably reasonable. But notice how I put so much of the pricing pressure into that operating profit margin. It's down to 5.5%. Now, despite the current economic headwinds, Abercrombie's management in the past quarter expects revenues to grow to $4.1 to $4.3 billion by 2025 and to $5 billion over the longer term, which I set to 2031, with margins initially increasing to 8% and then to 10%. So you can see in 2025, I do forecast revenues growing to around $4.2 billion, with those operating margins getting to around 8%. And then by 2031, I do forecast that revenue gets to around $5 billion and those margins get closer to that 10% level. And the really interesting thing, as I was looking at Abercrombie & Fitch, is that the company has an extremely clean balance sheet with excess capital equating to approximately $9 per share. Now, why does that $9 per share matter in this situation? Well, because the share price has been taken so far down that now that $9 per share is more than half of the valuation of the company. So you can see here that at the current share price of $7 per share, that 8.72 of excess cash is approximately 50% of the valuation of the company. And just using a low multiple of 12.5 times earnings, I believe that Abercrombie is one of the cheapest companies in the universe of companies that I've modeled in the tracker if you use what management is guiding to in their medium and long-term estimates. So the real question is, will management get to those levels? A lot of people believe that they're going to struggle and they're not going to achieve those estimates, and so they've really penalized the stock, but this is a name that I've been adding personally to my portfolio. Now, how do you get access to that model that I just walked you through for Abercrombie, but also how do you get access to the Walmart models and the Target models? Well, you can get access to all of those models at the lower Patreon tier. And the one thing that I don't talk about a lot is that I do an epic live presentation over a Zoom call with all the upper tier Patreons every month, and my very best work is reserved for that call. In fact, sometimes what we do is we do a live valuation on that call. One of the ones that we recently did was Stone Corporation, which is a name that's owned by Buffett. and it's a name that's not on the tracker, but it was a model that was given to the Patreons at that upper tier level. And so if you want to get access to all of that interesting and unique discussion points, you can get access to that. But the other thing that I do want to point out is that there's never any risk to you, because that's how much I believe in the product. So if you decide to try it out and it's not for you, no problem. Cancel it, but let me know before you do it so I can refund your first month subscription, so there's no monetary risk to you, which is really good in a recessionary environment. Now, I recently talked about the downturn at Walmart, and it's very interesting to really go through it and what their strategy is to come out of it, and you can get to that video right here.